Welcome to this explainer. Today we are decoding one of the absolute most frustrating mysteries in trading. We're going to break down how to predict and actually capture massive market movements just by tracking scheduled macroeconomic news. Honestly, if you've ever felt like the market is actively hunting your positions, like it's out to get you, well, this analysis is going to completely change how you view the charts. To make this super actionable, we've broken the explainer down into 6 quick parts. First, the secret behind big moves. Then, tracking global economic news, followed by decoding the market data. After that, we'll hit key events to watch, navigating the Indian market, and finally, your essential trading toolkit. All right, part 1, the secret behind big moves. Let's jump right into the exact pain point that wipes out so many beginner and intermediate traders every single day. Look, we've all been there, right? You do all your technical analysis, you meticulously place your stop loss, and then out of nowhere, you get knocked out of your trade by this massive, seemingly random green or red candle on gold or Bitcoin. You probably sit there thinking the market is just being chaotic. But the source material we're analyzing today reveals a pretty hard truth. These massive stop loss hunting spikes, they are almost never random.
Here's a perfect example. Picture this. It's July 29th, exactly 11:30 p.m. Suddenly, a massive spike hits the global charts. Just a giant green candle on gold and Bitcoin that completely wrecked anyone holding a short position. But again, this wasn't random market noise. 11:30 p.m. was the exact scheduled release time of the federal funds rate. The smart money knew it was coming. The institutional players were waiting for it. And if you didn't know that schedule, well, unfortunately, you were just liquidity for their trades.
That brings us to section 2, tracking global economic news. Because if the big players know the schedule, you absolutely need to track it just like they do. Our source material points out that a public economic calendar, like the one on investing.com, is basically your ultimate cheat code. It lets you filter by month and see exactly when these major reports are going to drop. Now, you might not know what the actual numbers will be before they're released, sure, but just knowing the exact minute volatility is going to strike, that lets you step aside, tighten up your risk, or strategically position yourself for a massive breakout. If we look chronologically at the month of July, we can see major scheduled global events that all perfectly aligned with sudden, aggressive market movements. July 1st, we had the ISM manufacturing PMI. The very next day, the unemployment rate. Then an FOMC meeting on the 8th and CPI data on the 14th. Every single one of these scheduled events acted as a massive catalyst on the charts. So, moving on to section 3, decoding the market data. Knowing the timeline is critical, right? It stops you from flying blind. But your real edge comes from knowing what to do the second the data drops. There's a fascinating inverse dynamic here, which brings us to a golden rule from our source material: everything is priced against the US dollar. So if US economic data beats expectations, meaning the actual number is higher than the forecast, it generally strengthens the US dollar. And a strong dollar hurts assets priced in it, so Bitcoin and gold go down. But if the actual data misses the forecast, the dollar weakens, and a weak dollar causes Bitcoin, gold, and even the Indian rupee to pump. Let's actually look at how this plays out in reality, because the data proves this thesis over and over. On July 1st, the ISM PMI forecast was 53.8, but the actual came in lower at 53.3. The result? A weaker dollar and an instant spike in Bitcoin and gold. The very next day, non-farm payrolls completely missed expectations. They predicted 114,000 jobs, but only delivered 57,000. Again, massive positive moves for Bitcoin and gold. And then, on July 14th, inflation, or CPI, came in cooler than expected at 3.5%. The market reaction was immediate, explosive, and heavily in favor of crypto and precious metals. Which leads perfectly into section 4, key events to watch. Now that we have that golden rule established, we need to isolate the high-impact catalysts. You don't have to track every single little report. The source gives us a specific checklist of the heavy hitters you need to watch. The US Federal Reserve basically acts as the central bank for the entire world right now. So any interest rate decisions or FOMC statements from them, those will send shockwaves across global markets. You also need to keep a close eye on CPI, which is inflation, along with unemployment data, GDP reports, and major political elections. Seriously, when these events are on the calendar, expect fireworks. Okay, section 5, navigating the Indian market. Global data sets the tone for commodities and crypto, for sure. But let's shift gears and look at how to apply this strategy to domestic data. If you want to clear out the global noise and build a local trading strategy, our source recommends a super simple 3-step setup on your economic calendar. First, jump into the country filters and just select India. Next, set your custom dates to view the entire month ahead so you're never caught off guard. And step 3, look at the event importance, which is usually marked by stars. You really only want to focus on those high-impact 3-star events. So, what are those high-impact events for India? Well, you've got RBI interest rate decisions, which dictate borrowing costs for the whole economy. You also want to track reverse repo rate updates, bank loan deposit growth, and, this is a big one, FX reserves data. The source notes that when India's FX reserves come in higher than expected, it usually acts as a really powerful positive catalyst for the Indian rupee and the domestic stock market. Finally, we have Section 6, your essential trading toolkit. To efficiently track all this macroeconomic data and actually execute profitable trades, you've got to have the right platforms. The source material recommends a couple of specific platforms to give you an edge. For crypto, Delta Exchange is highlighted as a great tool for executing futures contracts when those volatile global news drops hit. And for equities, especially if you prefer a more hands-off, data-driven approach, the source points to Investing Pro for finding AI-driven stock picks. And if you want to know just how powerful those tools can be, get a load of this contrast. During a recent one-year period where the broader Nifty 50 actually delivered negative returns, the Investing Pro AI portfolio stayed positive. But here's the truly staggering part. Over a maximum tracking period of about 6 to 7 years, the Nifty 50 did a 123% return. The AI-curated portfolio? A massive 1,000% return. It absolutely proves the power of aligning your portfolio with deep analytical data.
As we wrap up this explainer, I want to leave you with one final thought. The major institutions are using this exact public schedule every single day. The data's out there, the times are set, and the market reactions follow predictable historical patterns. So the only question left is, will you start using this calendar to optimize your trades and protect your capital? Or will you keep flying blind and let the news trade you? Thanks so much for joining me on this explainer. I really hope this data gives you a powerful new edge in the markets.